I read a lot of articles here on Seeking Alpha, and this one caught my attention, and it's really good. I think a lot of you are going to enjoy this. It's titled, "If I Had to Retire with 10 Dividend Aristocrats, It Would Be These." And the article was written by Robert and Sam Kovacs. I've been following them here on Seeking Alpha for a while. If you've never heard of them, they're a great follow. They create great articles here on Seeking Alpha. And you're not crazy. Today is Thursday. I'm creating a second video a week here now on my channel. After 5 years of only creating videos on Sunday, I'm now deciding, I have a little bit more time on my hands. And so I'm creating these second videos a week here on Thursday. And it's where I review articles like these here on Seeking Alpha. And I try to make it more educational, more informative around, the different topics that catch my attention. And that's what we're going to take a look at in today's video. So if you're a new dividend investor or you're trying to build a dividend portfolio, these guys, Robert and Sam, they hit the nail on the head when it comes to understanding your time horizon, understanding that you don't just look at a list of dividend stocks and just blindly invest in them, but rather understanding growth rates, dividend yields, and your time horizon. I think there's a lot to unpack here. And I think if you're new to dividend investing, if you don't understand this, this is going to be a big eye-opener for you, especially if you want to one day live off of your dividend portfolio like I did here last year at the age of 37. So let's take a look at the article. It starts off here with them saying, if you want a massive dividend snowball, get the right combination of dividend yield and growth for maximum compounding effect. Dividend aristocrats may not always be the best choice due to high valuations and low yields. Now, really quick, the high valuations, this is what I like to call the Buffett effect. A lot of dividend stocks or dividend aristocrats, some of them which Warren Buffett invests in, they get this higher premium than maybe other dividend stocks. And in many cases it's well deserved, but it can be very difficult to buy into dividend aristocrats or kings, at a kind of a fair valuation. Usually when the market corrects, they don't go down a whole lot unless there's something, under the surface going on. We saw that with 3M, with AT&T. There are some exceptions, but generally dividend aristocrats trade at a premium because they are generally higher quality companies and they're really, really well managed and well run. They continue with the article writing here, I refined a list of dividend aristocrats from 60 plus down to 10 based on yield and growth rates if I had to pick just 10. And they are, once again here, Robert and Sam Kovacs, and they run an investing group here on Seeking Alpha. They start off the article with, in a recent article titled Sell Alert, 3 Dividend Aristocrats That Will Kill Your Passive Income Snowball, I made the case that for dividend investors that wanted to see their income compound at phenomenal rates, blindly investing in popular dividend aristocrats was not the way to go. You see, our methodology is quite simple. Based on how long you got to retire, or if you're already retired, find the right stocks which will give you the most bang for your buck when it comes to dividends. This can be achieved by balancing out dividend yield and dividend growth in the current dosage. Now, if you follow the channel, I talk a lot about this. It's really finding that right mix, that right balance of the current yield and the dividend growth. And generally, if you're dollar cost averaging, you want to kind of look at historical yields. If you're lump sum investing, say you just sold a house or you just, you're retiring and you have a lump sum of money to invest, you really want to make sure that you get the right sauce, the right mixture of the yield and the growth. And that's what they're discussing here in this article, and they share how you can look at this. It's a little bit elementary, this next part, because they actually describe what a snowball is. So I think most people, we don't want to insult your intelligence of what a snowball is. Humor me here. I'm just going to read this part. Maybe there's somebody out there that doesn't understand the dividend snowball and what it really means. If you do this right, then your dividends will snowball. I explained this in detail in an article humbly titled Sam's Dividend Income Snowball Retirement Masterclass. And here he just generally explains what a snowball is. So stay with me here. Imagine you are at the top of a hill holding a snowball. This snowball represents the dividends you'll receive in the first year you start investing. Of course, the size of the snowball is determined by 2 factors: how much cash you can invest in a dividend stocks and the dividend yield of the stocks which you choose to buy. More cash creates a bigger snowball, as does a higher yield. Now, as you let go, the snowball begins to roll down the hill. As the snowball rolls down the hill, it starts to gather more snow, becoming larger and larger. This gathering of snow symbolizes the growing dividend checks you receive. When you reinvest the dividends, this packs more snow onto the snowball. If you're not yet retired and are making monthly contributions towards your portfolio, this too packs on more snow. This reinvestment increases your principal, which in turn generates more dividends in the next cycle, causing the snowball to grow faster and faster. Now consider the slope of the hill. This slope represents the growth rate of your dividends. Stocks with higher dividend growth rates cause the snowball to gain momentum more quickly. So we have a visualization of the dividend snowball, how that works in combination with the yield and the dividend growth. The problem, I argue, with many dividend aristocrats is that they have been growing their dividends for so long that they've essentially driven themselves out of the dividend competition. Each year you increase makes it harder to increase by the same relative amount the next year. Increasing by 10% when you pay out 1 million is easy. Increasing by 10% when you pay out 10 billion in dividends is a whole nother matter. Some of these companies are viewed as safe, stable, blue chips, steady eddies, and as such have very high valuations relative to their earnings and to their dividends. That is to say they have a low yield. Cough, cough, Walmart. Of course, this is the case of some dividend aristocrats, not all of them. So in this article, I wanted to highlight that if I was forced to retire on 10 stocks, that they could be dividend aristocrats, that they could only be dividend aristocrats, then I could still build a suitable list of stocks. Now, it should be noted that I don't think a 10 stock portfolio makes sense for anyone except someone who is starting from scratch and wants to progressively and add more stocks over the course of the year or two. That in that case, a 10 stock portfolio might make sense, but even then, it would be a transitory, are you drone pal? Transitory phenomena, transitory. Who knew what transitory meant before the whole, pandemic? So anyways, I like what he says here. 10 stocks are definitely not enough if you're planning on living off of your dividend portfolio, unless you follow what I like to talk about, the simple path to wealth, where the core portfolio makes up, dividend growth ETFs like SHD and DJRO. What he's describing here is great if you want to add on these dividend aristocrats in addition to your SHD and DJRO, which I talk about. So just these 10 stocks alone, no one, he's arguing and I argue, no one should do that unless you're just starting out and you're dipping your toes in it and you're just figuring this whole thing out. But what he's suggesting here goes so smoothly, so well with the simple path to wealth with dividend investing that I talk about on my channel. If you never heard of that before, go check out my videos on the simple path to wealth. At the end of the video, I'll have one of those videos pop up and you can watch that video next. But it complements it so well what I talk about on my channel. So the current dividend aristocrats list, below I compiled the current list of dividend aristocrats and sorted them by dividend yield. In the second column, I included the median 10-year dividend yield. And in the two last columns, I included the 1-year and 5-year dividend CAGR. Now this median 10-year dividend yield, this is incredible, guys. If you're dollar cost averaging into your portfolio, this is the metric that you want to use. I'm curious what website he used to gather the 10-year dividend yield. On Seeking Alpha, they only have a 4-year average dividend yield. So this is really cool. If you're dollar cost averaging and you use a spreadsheet, guys, pause the video on the stocks that you own and maybe you kind of steal this from them, or copy it from them. It's this is a valuable metric, especially if you're dollar cost averaging, because you don't want to take the forward dividend yield. You want to take what, you're using assumptions, right? When you're projecting future returns. So using the 10-year dividend, average dividend yield, that's huge. So I'm not going to review every single one of these one by one, but notably the dividend aristocrat with the highest dividend yield right now is Realty Income with just under a 6% yield. You got Ben, Franklin Resources. I think this is a financial. When I first built my portfolio, I invested into Ben and I shortly thereafter sold out of it. Thankfully, it's kind of crashed since then. I'm a genius. I bought low and sold high and before it crashed. Anyways, I'm by no means a genius, insert MPW. But you can see, the dividend aristocrats here. You can pause the video if you want to see some. There's some of them that I invest in. I like JM Schmucker. It's had a poor year. They just acquired Hostess. This is more of an emotional buy. I love peanut butter. And so it's like, my satellite positions are more of like it's an emotional buy. I love my JM Schmucker. And, you got others in here. You got IBM, you got Hormel, you got AbbVie, a few of them here that I own. And the list goes on and on. Like I said, you can pause the video here if you want to take a deeper dive into one or the other. And once again, this is right here. This column is the 10-year average dividend yield, or the median dividend yield. Okay, moving on here, refining the list. The task of cutting from 60 plus to 10 is quick and fast to start with, then it gets slower as we get closer to the final list. To start with, I will cut out all 26 stocks with yields less than lows. So all of these stocks which yield 2% or less don't have anywhere near the growth rates to justify these small yields. This is, once again, guys, how to invest based off of your investment time horizon. This article is skewed more towards those who are nearing retirement. So if you're in your early 20s, maybe you do the reverse of kind of what he's suggesting here. If you have decades before retirement, or when you plan on living off your portfolio. What do I mean by that? So let's compare two stocks, one that will make the list of 10 and a few from this subset that I just cut. So Chevron currently yields 4.17%. Last year, it increased its dividend by 8%. Over the past 10 years, it averaged 4.3% dividend growth. During the past 5 years, it averaged 6.5%. By how much do we believe it will grow over the next 10 years? 5% seems like a reasonable benchmark. If you invest $10,000 in Chevron at the current price and reinvest dividends every year at the current yield while the dividend grows at 5% per year, then in 10 years, you can expect to receive $919 in dividends. And you can kind of squint your eyes a little bit on the graph here. You can see, the red part being the initial investment and the light blue teal color here representing the growth. Now let's compare that to the stock with the highest 5-year growth rate in those 26 that I'm cutting, and that is Nordson, ticker NDSN. Nordson has been growing its dividend at a 14% CAGR over the past 5 years and over the past decade. Sure, in the last year, it increased at just 5%, but for the sake of proving a point, let's assume that the dividend continues to increase at 14% per annum in upcoming years. Nordson currently yields 1.17%. We'll simulate how a position in Nordson will snowball over time. You wouldn't even get half the income 10 years from now. So you get $417. So guys, this is why I harp on how to invest based off your investment time horizon. This dictates everything. You don't want to just go read a blog or watch a YouTube video and see a list of, the best 10 stocks to buy in July. Right? That's cool to get inspiration, but even more important is you want to understand, is this relevant for you? Does it fit your time horizon? So look at everything that you're consuming on social media when it comes to investing content. Look at it from the lens of, does this apply to me or does it not? Okay, because it can be, we talk about not blindly just investing into a Dividend Aristocrat just because it's a Dividend Aristocrat. Not all Dividend Aristocrats are created equal, and that's what they're very clearly depicting here in this article. So moving on, the more astute of you, however, would realize that the relation of Nordson to Chevron's dividends went from about 1/4 in year 1 to about 4/9 in year 10. Of course, a higher growth rate will always eventually catch up with a lower growth rate. It is bound by the laws of compounding. I love that. I love that. But in the case of Chevron versus Nordson, the Nordson income would finally overtake Chevron's income in 25 years. Guys, this is it. Like, this is so great. Like, I love this article. This is so great. And it's so important that you understand this. And that assumes that you can actually achieve the 14% dividend growth every year for the next 25 years, which is very unlikely probably, guys. As we saw earlier, 10% of 1 million is nothing, 10% of 1 billion is a lot. Something which is harder to bank on, given it suggests it would need to increase by a factor of 25 times. The message is quite clear. While low yield and high dividend growth eventually beats high yield and low growth, it really only makes sense for investors who have decades before retirement. Hallelujah. Hallelujah. Exactly. This is what I've been saying for years, and it's so great to see it on, in black and white in text here. And even then, you'd want to stick to those that are able to grow their dividends, at least in the teens, if you're focusing on stocks with less with yields less than 2%, less than 1.5%, and I'd be looking at least for a 20% annual dividend growth potential. Here, let me make a quick comment here. So years ago, I would always avoid, looking at like VIG or, some of these other high, low yields, but high growth rates like the S&P 500, because it doesn't make sense if you're a dividend investor to focus on those investments, especially what he's talking about right here, unless you have decades and decades. And even then, it's never a guarantee. And that's why finding kind of that sweet spot, that's why I like SHD and combining it with DJRO. And then depending on your time horizon, you can either reach for more yield or more growth, depending on where you're at in your time horizon. So moving on, low yield and low growth is a dividend snowball's death wish. Let's look at Emerson Electric as an example. This stock currently yields 1.9% during the last decade. It has grown its dividend at a 2% CAGR. This has slowed down to a 1.4% CAGR over the past 5 years, and it's just a 1% increase this last year. Oh my gosh. It spells like 3M all over it. Well, 3M has different issues, right? They have legal issues, maybe like an AT&T. I don't know what the debt is for Emerson Electric, but the growth rate's abysmal. Now let's say you've been that you were going to invest $10K in Emerson and reinvested the dividends every year. While the dividends continue to grow just at 1% per year, then in 10 year, you'd expect $247 in annual dividend income. And in 25 years, you'd expect $381 in annual income. Horrible. Okay, if we're using our snowball metaphor, you're trying to get a snowball going by dropping a snowflake onto a 0.5 degree slope. It's not gonna happen. Cardinal Health, Colgate, Walmart, Chubb are all in that category. Dividend snowflakes. Ooh, man, shots fired. Whew. Colgate, yeah. Walmart, yeah. Chubb, yeah. And then you add on the international tax with Chubb. No, thank you. Though I think Chubb did have a really good dividend growth rate here this last year. And I know that Warren Buffett just invested into Chubb, but I'll pass. At least for me in my time horizon. But anyways, let's take a look. Further refining favorite business models. At this point, I'm at the crossroads of my selection because there are a lot of these businesses which I fundamentally like, just not at these prices. In fact, the following is true of virtually all of the stocks on this list. At the right price, they are a buy. The reason I discard the 26 above is that they've been at high prices and low yields for so long that the perspective of them trading at an attractive yield in the near future just seems quite remote. So it's the Warren Buffett effect, right? It's really difficult to buy into these high quality companies. Usually they only go down when something's seriously wrong or something, right? So from the lower yielding to the higher yielding, these are some of my favorite business models. I'm not going to read everything in detail, but I'm just going to list them. He's got Lowe's, I think, Lowe's versus Home Depot, retail, Aflac Insurance, I believe. Aflac, they got the funny duck logo. ADP, Procter & Gamble, McDonald's, Air Product and Chemicals, Nexter Energy, Target, Coca-Cola, Pepsi, Exxon, Medtronic, AbbVie, IBM, Chevron, T-Rowe, Federal Realty Trust, Investment Trust, and Realty Income. Not to say the others don't have great business models, but these are by far my favorite and are not tainted by accounting scandals, legal woes, or other pains in the neck. So this is subjective. These are just his personal opinions. Now, this has helped a lot and reduces our list to just 18 stocks. If we're going to retire with just 10 stocks, we try to strive for as much diversity as possible. So we won't want PepsiCo and Coca-Cola, just one of both. We wouldn't want Realty Income and FRT, just one of both. I'll remove Coca-Cola because Pepsi has proven a track record of growing faster, and Pepsi yields more today. I'll remove FRT, MDT, XOM, which is Exxon, and for the same reasons. Okay, so he's not doubling down in the same sector. So now they're down to 14 and 4 still need to be axed. I'll remove Target because if we keep just one consumer discretionary stock, it should be McDonald's. I'll remove Procter & Gamble because once again, Pepsi is better in the staples category. And I'll remove T-Rowe because it has, if we're going to keep just one financial, Aflac has demonstrated better management and doesn't face the displacement from passive investing that T-Rowe does. Okay, interesting. Good. I mean, right now he's crystal balling, so you could kind of take the contrarian approach to what he's saying. This is just merely his opinion. It's a good opinion. I tend to agree with what he's saying, though. And there you have it. We're left with our list of 10 aristocrats we'd retire with if we had to. And the list of 10 dividend aristocrats, and we sorted them by low yield to high yield. Okay, so let's take a look at these. The first one is going to be Lowe's. I like Lowe's. I invest into Lowe's as well, personally. So Lowe's currently trades at $220 and yields 2.09%, which is above the 10-year median yield of 1.77%. During the past 5 years, the dividend has grown at 16% CAGR, which is amazing. 16% dividend CAGR for a retailer. I mean, you do have the pandemic, so I'd rather see the 10-year. And there you go. Over the past 10 years, it's been more at 17%. Okay, I wasn't finished reading and I jumped to conclusions there. That's great. I believe that Lowe's will grow the dividend at 10% going forward, which suggests that if we invested $10,000 today at the current yield and reinvested the dividends, then in 10 years, we could expect $584 in yearly income, and in 20 years we could expect $1,828 in annual income. So as you see, the snowball grows the more time you have, because this is a lower yield, higher growth rate. With Lowe's, while Lowe is historically undervalued, these numbers suggest that it will be that to be truly happy investing in Lowe's, I need a higher dividend yield or a higher dividend growth rate. Unsurprisingly, Lowe's is currently on our watch list and hold list. So yeah, with Lowe's, these ones are great when you can buy them on a dip or when the market kind of corrects at like 10%, the overall market. So Aflac currently trades at $89 and yields 2.25%, which is below its 10-year median yield of 2.4%. During the past 5 years, the dividend has grown at 30% CAGR, and over the past 10 years at a 10.5% CAGR. This last year, they increased the dividend by an impressive 19%, and I believe another big dividend increase in coming this year. Yeah, all these insurance companies, these SOBs, like my car insurance, my house insurance, over the last 3 years, it's up 100%, right? Like, no wonder they're growing their dividends so there's a reason why Warren Buffett invests into insurance companies, right? Geico and all the others. It's because they have a monopoly. They set the prices. Yeah, sure, they could have a bad year. There could be a big storm, like there's one right now actually in Houston, but they've done historically very, very well, and they have a monopoly when it comes to setting the price. What are you going to do? Not insure your car? What are you going to do? Not insure your house? It's just, and I want to say, like, I'm kind of getting off on a rant. It's like they're all colluding. Like, they all use software to track each other's prices. So, like, you might think that, oh, my insurance has gone up. Let me go shop around. Well, guess what? They're all going up, and they're fixing the costs. It's like the old gas stations back in the day. It's probably still happening, where they have a monopoly and they set the prices. And oh man, it bugs me. I'm sure it bugs you too if you just had to renew your insurance. Anyways, moving on, I believe that Aflac will grow at a 12% going forward, which suggests that if we invest $10,000 today with the current yield, reinvest the dividends, then in 10 years, we'd expect $742, and in 20 years, $2,810. My rule of thumb is $800 on 10K in 10 years. Aflac is very close, and for investors with a longer time horizon, it makes a lot of sense at the current prices. ADP, I'm not going to read all of the numbers here, but you can see, they've grown their dividend at 12% over the last 10 years, 12%, and he believes that they will grow it at another 12%. And just the longer you have, the longer time horizon that you have, the more income that you're going to get. I'm sound like a broken record here, but that's just the reality of how these work. And so you got McDonald's, which is about a 2.6% yield with an average of 2.4, so it's yielding a little bit higher than its historical average. The dividend CAGR over the last 10 years is 7.5%, and he's forecasting about 7.5% dividend growth. That seems reasonable, considering what McDonald's. And yeah, McDonald's is kind of an interesting one. I do like McDonald's. It's kind of a challenging one. I don't like eating the food, but they have such a great monopoly business model. They have such a huge moat. It's a great investment. I just don't. It's kind of like, it's weird. It's kind of like tobacco stocks, sin stocks. How is McDonald's any better than a tobacco company? Now, okay, before you rush to the comments and freak out on me, or like Pepsi or Coca-Cola, right? You either get diabetes or you get cancer, right? Like I just pick the best of the two evils. I don't know. It's, when you think about that out loud, it's like, man, it's corporate America, man. They just want to squeeze every profit no matter how much they may hurt their consumers. But then they can say, well, you don't have to eat at McDonald's 3 times a day, which is true. Everything in moderation, guys. Everything in moderation, even in your dividend yield and your dividend growth. Next, our energy, utility one, 11 dividend CAGR. I wonder if they're going to be able to keep up this dividend growth rate with NextEra Energy. Really good historical performance with NextEra Energy. If you were to invest into this one in 20 years, $10,000 would produce $2,923. So decent dividend growth, I guess, a good dividend mix. PepsiCo is a good one. I currently own Pepsi. I like PepsiCo. The thing about Pepsi the reason why I have it highlighted here is they have such a monopoly and a moat around their supply chain. You see what's happening with Celsius. All PepsiCo had to do, so PepsiCo invested into Celsius, and then now they're reducing Celsius's inventory. They have such a monopoly over the distribution and the supply chain of drinks and snacks across America that it's so hard for a small little company to enter in the market, because PepsiCo, they can say, yeah, come on, Celsius, we'll distribute your drinks everywhere. And then all of a sudden, yeah, we're going to reduce your inventory by 20%, and we're no longer going to do that. Like for better or for worse, they're kind of like Google. They're maintaining their monopoly. They're not going to let anybody come in and take market share from them, no matter how ethical or unethical it is. Anyways, PepsiCo, 7.5% dividend CAGR over 10 years, which is reasonable for this business model. I personally like it a little bit more than Coca-Cola. I like the brand of Coca-Cola better, but PepsiCo has done a better job at diversifying, getting into snacks, other areas, diversifying their business, where Coca-Cola, not so much, but Coca-Cola is more prominent in restaurants. And so they're very similar. But in terms of the dividend growth, I do like PepsiCo a little bit more. You got AbbVie here. AbbVie is also one that I own. I bought AbbVie back in 2019 in the 60s. It's been one of my best performing stocks along with Costco. But yeah, AbbVie, it's going to be questionable if they're going to be able to continue this dividend growth rate. During the past 5 years, they've had a 7.7. Over the past 10 years, a 10 CAGR. I'm not reading everything because I don't want it to be super redundant. If you're interested in a specific one of these, specific company, you can pause the video and you can take a look at it here, the dividend metrics. But yeah, the next one here is IBM. IBM has been an interesting one. They've kind of come back to life. They were presumed dead for decades, and now they're back. But the ninth one here is Chevron. This is a good example. The one that he highlighted earlier trades at $156, yields just over 4%, dividend CAGR of around 4% over the last 10 years. They're expecting or projecting about a 6% dividend growth rate. Like this one, I mean, this is a pretty impressive one. I mean, Chevron, if they can continue it, it's done. It's hard. The numbers don't lie. Like they've done very, very well. I'm not bullish on energy or, oil stocks, but it's hard to deny, in the near term, it's done. It's going to do, I think it's going to continue to do very well. I don't invest into oil directly. I get exposure to oil through SAHD. SAHD owns a few oil companies, so I get exposure that way. And then the 10th one is Realty Income. Trades at 53, yields just under 6%. And the dividend CAGR on this one's been about 3%, 3.7 over the last 10 years. In the last year, it increased by 2.9%, and I believe this is a fair amount to project going forward. Realty Income's size challenges future growth, but the international opportunity enables this modest level of dividend growth. If we invest $10,000 today at the current yield and reinvest dividends, then in 10 years, we could expect $1,296 in yearly income, and in 20 years, we could expect $3,064 in yearly income. And it won't come as a surprise to learn that Realty Income is still a buy on our list at these prices. So in conclusion, I wouldn't want to own just 10 stocks to retire, and particularly I wouldn't want to own just Dividend Aristocrats. Even of these 10 I'd be happy to own. It would only make sense at certain prices. Only a subset of Dividend Aristocrats makes sense for most portfolios, and for investors who are looking for more yield because of a lower time horizon, very few fit the bill. If you take away anything from this article, I'd like it to be the best combination of dividend yield and growth depends on your time horizon. And then the second thing here is even the best companies are only buys at the right price. I like to close this article with a great Warren Buffett quote. Whether it's stocks or socks, I like to buy good quality merchandise at a discount. Really great article, a lot to unpack. It really helps you to understand and visualize the income portion of it with your time horizon, understanding yields versus dividend growth rates and the dividend snowball. Really, really well written, great article. And let's take a look at some comments here. The first comment that I wanted to take a look at is, unfortunately, this strategy has not really worked in the past 10 years, as it does not take into account that most of these types of stocks have vastly underperformed the overall market. In fact, those that pay no dividends, like many high-growth tech companies, have blown away these stocks on a total return basis. As one who drank the Kool-Aid for this type of investing and seriously underperforming the market, I urge people to think long and hard about this. In fact, I can name lots of those stocks that would have fit nicely into this type of strategy that are a disaster total return wise in the past 10 years or so, like the often hyped AT&T, Verizon, Altria Group, just to name a few. It's a very, very fair comment, and that's why if you don't understand your time horizon and your goals, you can vastly, to quote this guy here, vastly underperform the market, and you would have been vastly better off to just go with the S&P 500 if you don't understand your time horizon and your goals. So this is kind of it's a reality check, right? If you don't know your goals and your time horizon, this guy generally is right on the surface. But it depends on who you're talking to. This article was more tailored to those who are planning on retiring sooner. So another person commented on this comment, the title of the article points to a retiree with a portfolio of 10 stocks. I'm on the verge of retiring, and from my perspective, I don't consider the overall markets as my benchmark. I'll want some growth, of course, but it's time to turn on the income stream. This kind of portfolio compared to the overall market isn't a reasonable benchmark. The title of the article gave that away. That's a really, really good counterpart. You're not going to tell somebody who's 65 to just go and, invest into high beta, volatile tech stocks in the overall stock market when they're looking to live off of the income from their portfolio. Okay? It's so important that you understand that. But yeah, on the contrary, if you're in your 20s, obviously, you want to focus on total returns and growth. You're not really interested in income. Okay. And the next article here, I think dropping Medtronics for AbbVie is a mistake. Medical technology and pharmaceuticals, biotech are distinct sectors, even if lumped together as medical by the S&P. In my honest opinion, the risks to pharmaceutical biotech sector are much higher than for medical technology. But overall, I like the thought process and your explanation of your decisions. Yeah, I think, if you work in healthcare and you understand the space, you might have some kind of insider understanding of that. For me, I like medical device companies better than pharmaceutical companies and drug companies. It feels like there's less of the boom or bust in that. But yeah, that's just my outsider looking in kind of perspective. And but the article, I thought that, they did an incredible job when it comes to helping you understand growth rates, dividend yield, and how to look at this from not only the perspective of today, but how is your income going to grow? We think about a 65-year-old. A 65-year-old could live another 20 or 30 years, right? So they still want their portfolio to grow, okay? But as they mentioned in this article, I would never just have a portfolio of 10 dividend stocks or 10 dividend aristocrats. You want to make sure that you diversify. And the best way that I personally know how to diversify is follow the core and satellite approach to investing, where you have a core portfolio of low-fee index funds like SHD and DJRO, and that makes up anywhere from 70 or 80% of your overall portfolio, depending on your time horizon. And you have a satellite position that meets your goal, whether you need more growth or you need more yield, and you limit how much you have invested in each individual stock. And that is what I call the simple path to wealth with dividend investing, which was inspired by J.L. Collins, who wrote the book, The Simple Path to Wealth. And I apply that using the core and satellite approach to investing. But yeah, I hope that you found the article as interesting as I did. I hope that the video was helpful for you. As always, I'll be back next week on Thursday. And as always, on Sundays, I'll have my regular videos. The format to those videos will be unchanged. Hope everyone has a great week. We'll see you on Sunday. Thanks for watching.